What's up, everybody? So with interest rates at nearly 3.2% on a 30-year fixed mortgage, is now really the best time to go ahead and purchase a new home. There's some economic things that I think you should consider before you make that final decision. Stay tuned. We're going to talk about that coming up next. Hello everyone, my name is Paul Zachary Shelton Jr. and I'm the Chief Investment Officer of Warwick Advisors. We are a wealth and investment management firm located in Orlando, Florida with clients all across the United States. If this is your first time coming to our channel or seeing one of my videos, I ask that you please subscribe to this channel. Please ring the bell so that you can get a notification each time I upload a new video. Also, please like and share this video to help me increase the financial literacy of our globe. Before I get into today's topic, I want to offer you a free financial planning cheat sheet. This cheat sheet will provide you with the asset allocation that can be used in today's current investment landscape, and it will also give you a snapshot of where you are in your personal financial health. It'll allow you the building blocks to be able to build and increase your credit score and also protect your assets from any of those creepy creditors that may come along the way. What's up, everybody? I'm so excited that you helped me get to and surpass the 10,000 subscriber point that I'm going to be doing a free giveaway, and it's more than likely going to be used on the Cash app. So interest rates are at all-time lows, and really interest rates have been dropping for the last few decades overall in aggregate. As of now, the Federal Reserve has committed to a monetary policy that is very accommodative in light of this economic recession that we are in, driven by COVID-19. They're maintaining a posture of keeping interest rates low and keeping them low for pretty much the near-term, intermediate-term future. Those are some of the things that I see over the next 12 to 18 months. But however, is this really the best time to go out and buy the house? Is this really the best time to take on any new debt? Given where we are in this interest rate environment, is it very, very possible that there could be some risk out there for those entering into the home market at this time? Currently, right now, the average mortgage rate is 3.18%. This is compared to a year ago when that same rate was roughly 3.8%, almost 4%. Rates have dropped significantly, which is a good thing, because as interest rates drop, it'll allow us to buy a larger house or buy more home, and we can afford more. Essentially, our dollar that we're using to invest with, or that we're using to purchase our home with, goes a little bit further than it did a year ago. As of last week, the homebuyer applications have increased by 5%, which is a good sign to see, especially in this phase of a economic downturn / trough / recovery. Depends on wherever you believe we are in your economic theory. And over the last year, mortgage applications are up 18%, which is a very, very positive thing. However, all of those that are purchasing homes right now, or that may have purchased a home over the last 5 to 6 months, it's very possible that two things could play out in our economy over the next 2 years. Possibly, we may see another spike in unemployment, and we may see a spike in inflation. If both of those scenarios play out, that could potentially be negative for those who recently purchased a home. I'm explaining why. With over 40 million people unemployed in this country, and at least 20% of them expected to be permanently unemployed, it is very possible that the economic recovery will not keep pace with the stock market recovery. There are certain sectors of our economy that will fare well as the economic recovery moves along. Primarily, the defensive sectors of the economy will see less employment volatility in the near and intermediate future. There is risk of a second spike of unemployment filings as the economy struggles to re-engage those that are permanently unemployed. I anticipate this is possibly going to play itself out and take place in the next 18 to 24 months. If that happens, if we do see a second wave of unemployment spike, because approximately 8 to 10 million people will never regain employment, this would place new homeowners in a financially stressful situation. Financially stressful for a couple of reasons. One, you may lose your job, or you may fall on hard times financially. You may be furloughed, hours may be reduced, salary may be reduced, all sorts of things may happen. At the same time, whenever you do see a high amount of unemployment in any economy, you typically see a reduction in home sales. Now, a lot of the sales that have taken place over the last month or two has been related to sales that were already under contract and some pent-up demand that was out there heading into the current season that we are in right now. If we do see a spike in unemployment, it is very possible that home sales will trickle down and they will slow down a little bit. And at the same time, with that lack of demand for new housing and lack of demand for existing homes, we will more than likely see the value of current homes drop. And it is possible that over the next 2 years, those current home values will drop, causing many new homeowners that purchase within the next 6 to 12 months to be underwater if that scenario plays out. Additionally, the amount of free money and free cash that's been given through the CARES Act, through the PPP loans, and through all the economic stimulus that has been disseminated in this country could potentially lead to high inflation. I dare not say hyperinflation, but it could lead to a point where interest rates, inflation rates are rising. And what will that do for our economy if inflation and interest rates are rising and cutting off the demand that is there for housing? If our economy realizes rising inflation, rising interest rates, and continued high unemployment, the real estate market will experience headwinds and values will drift lower. This will place new homeowners underwater, like I mentioned before, underwater in their mortgage at a time when it is not advantageous to refinance or to sell your home. For these reasons, I believe that the time to buy real estate is truly dependent upon your personal situation. It could be advantageous for you to purchase a home right now if you're working in one of those defensive sectors of the economy and you feel that your personal income is safe and protected against what's going on externally in our economy right now. However, if you're in a cyclical nature, if you're in an area where your employment is very cyclical, I would encourage you to weigh all your options when purchasing a home right now, just to make sure that you're not purchasing possibly at the market top with a trough or a bottom due to come soon in the real estate market. So some of the things that you should do is really take your time, vet out the interest rates against your personal finances, against your overall wealth picture, and against your current income. Deduct your current income possibly by 30% to see if you would still be comfortable with purchasing that home if there was a 30% reduction in your personal income. And the reason I use this 30% is because most of the people that have seen furloughs recently or a reduction in income has received a 30% reduction in income. If you have any questions about anything that I mentioned, please leave a comment below. Please like this video. Please share this video to help me increase the financial literacy of our globe. Thank you so much and have a great day.